What is a bear market rally, and how do you tell the difference between a bear market rally and just a regular rally?
Yeah, we got this question earlier, so I've got some things prepared for this too. But it's really fascinating because, first of all, some definitions, right? A bear market is a down market. Theoretically, it is down 20% or more, right? But people use it all the time for just down market. So it kind of depends on who's saying it. Right now, we're over 20%. We're technically in a bear market. So down, bull is up, right? And so what happens is then the major trend and the minor trend. That's how I look at it. Major trend is down. Minor trend are these little pops back up and coming back down, right? So I'll show you an example here. Here's that. Here's a chart of the S&P 500 as denoted by the SPY ETF. I put some little yellow lines in there for some of the little rallies we've had. So obviously the overall downturn is the bear market. It's the major trend is down. And matter of fact, one of the indications for that is number one, being below the 200-day moving average, and number two, having the 200-day moving average coming down. To me, that denotes a downward market. Okay, and so these little rallies have been bear market rallies, right? Because they haven't turned into a full recovery. They've all failed, right? And market has gotten lower after those rallies. There's four big ones, including the one we're in right now. Now, one of the fascinating things about this, one of these bear market rallies will be the one that gets us all the way back, right, to the top. And it's very, very difficult to tell which one it is. I remember in the 2008 downturn when the market bottomed out March of 2009, it was a very dark period. Economically, things were really bad, and the market bottomed out in the middle of that. That's normal. So you really have to watch for certain things. Number one is, in my opinion, like fighting through resistance. So here we go. We have this green, blob on the side here, which is a volume profile. The longer that bar is, it means more shares traded at that price. And so the market's already fallen through that yellow line, is now trying to fight back through it. And it's going to be difficult because a lot of people bought at that price and it fell, and they want their money back when it gets there, right? So that's why it's resistance. And so in a true recovery, and not just a bear market bounce or bear market rally, you'll see the market fight through multiple levels of resistance. And so that would be something to watch for. Does it make it through this one? One of the other things that I would watch for is some volume, at least eventually, right? If the volume stays down during the up portion, it's just not enough energy and power to kind of get things going as far as that goes. So we're not seeing that yet. It is a 4-day week, so maybe that's the culprit. So let's see what happens next week. I mean, next week, having it fight through this resistance, having volume pick up, that'd be a good sign. I mean, it really would be that things are moving, in the right direction. And so, because the next, resistance level is up here.
Yeah.
So you break that first resistance level, you get into that second resistance level, you could really, see a recovery. So bear market rally is just a rally that kind of fails in a downturn, an upward rally that fails in a big downturn and ends up at a lower low, right? And a recovery is when that finally turns around. And a true recovery gets all the way back up to a new high, right? Which, if you look back there, was in January, second trading day of the year. And so, anyway, that's what it is. That's how it works, and that's how to watch for a recovery. Right now, as we sit, I don't see it, right, personally. But, we're all data dependent. We all have to wait and see kind of what happens, what transpires, and, react to that to a large degree. I mean, we can guess here, it's going to go lower, it's going to go higher, what have you, but it's better to have kind of some historical data that you can look at and look at what's happening right now and have some comparisons. So,
Do you think if we had some good economic data next week, could push the market to kind of break that resistance and have it continue the run?
Yeah, it could. I think the biggest issue, and I don't think there's much happening next week from the Fed, the inflation number when we get those, and then the wording from the Fed. I mean, they just keep coming out, and I mean, even just this last week, we had interviews and testimony. The word recession was mentioned the most I've seen so far this year, but by Fed governors or by Chairman Powell himself, as a possibility, talking about how difficult it will be to, bring down inflation because of the outside influences. So that's the problem that I would love to see some of that change, because we've had these rallies. If you go back and look at these tops that we've had in these bear market rallies, most of them have been extinguished by either the Fed themselves, what they've done that was a surprise, what they've said, or inflation numbers coming out that's making the Fed do, things that are more surprising, like doing a 3/4 point increase instead of a half because of the CPI number that came out, a couple of Fridays ago, right? So but I'll tell you what, that's how the market works. I mean, you can make all the arguments you want. It can climb a wall of worry. It can come all the way back. And most recoveries, and I call it the anatomy of a recovery, it starts with the market overextending to the downside, which you definitely see in that chart. That's a cascade, a waterfall that happened. And it kind of gets all the sellers out. It brings in some buyers, right? The only ones left. Doesn't take that many. Volume can be low. And boom, boom, you get this motion up. And then pretty soon all the hedge funds that are shorting, the market to death because the market's going to fall farther, they have to start covering those shorts. That becomes buys, right? And if they cover, they buy, and the market keeps going. So sometimes short covering short positions right now, according to articles I've read, are as high as they've been since 2008. So very high. And so then you start to get this kind of fear of missing out, right? FOMO. And so people just start pouring in, and then eventually the institutional money has to come in to really make it go. Volume is picking up, and you get this scenario where, they can't miss out, right? I mean, I compare myself to the Vanguard Total Stock Market Index, for example. And so, if I have lots of cash, which I do right now, and lots of ultra short-term bonds, which I do right now, I'm going to lose to this thing if it takes off. And eventually, at some point, I have to get back in, and that money will dump back in with everybody else. That's a recovery. That's how it works. But what we've seen so far, just in my opinion, is that when we get these big runs, the institutions aren't coming in. We're not seeing the big volumes on the upside. I think, they're very, very attuned to the Fed. And they don't want to fight the Fed. That's a very common saying. And they don't want to be, on the other side, the Fed is hammering and hammering and hammering. They want to wait until that point when the Fed starts to at least, get a little bit softer, or at least they can see that it will happen, right? At some point in the future, the market does look forward. It's hard to look real far forward right now with what's happening, but it's definitely possible. We could have set the bottom last week.
Yep.
So we'll see. So that's a good question.